Hello, strategic management students. It's Fred David here, working our way through the textbook. On chapter 8 today, going to be on page 247 in the 17th edition. If you have your book with you, please turn to page 247. We're going to talk about projected financial statements. You know what? There are 8 pages in the book on this one topic, projected financial statements. It's one of the most important topics there is in developing a comprehensive strategic plan, because your audience is going to need to be reassured that whatever strategic plan or set of recommendations that you are proposing or recommending going forward is financially feasible, that it's doable. Folks, I've attended many international case competitions where teams of students presented strategic plans to a set of judges on particular companies. And those that have always included projected financial statements have really been viewed very positively and have oftentimes won those events. Because otherwise, the audience has no assurance that what you're planning or proposing or recommending is even going to be doable financially. So this section starts on page 247. Like I said, it's going to be 8 pages. Actually, I'm going to need you to read these 8 pages line by line, folks. Take good care. This is an easy technique to master. And the beautiful thing is that the template is going to take the mechanics out of this for you. The strategic planning template that thousands of businesses use to actually do strategic planning. You see the icon on that template where you develop financial statements, which I think you've already completed. That is your existing statements. Remember in an earlier chapter 4, you converted your existing financial statements, as you see in your Form 10K or financeyahoo.com, into the template format. And this is talked about on page 248. You see on page 248 where it says template considerations in developing financial statements? It's reminding you there that you've already converted your statements into the standard template format for an income statement and a balance sheet. And then I see on table 8.4 on page 248, it gives other considerations there. It reminds you that in performing projected financial statements, you're going to start with the income statement. And that means with the revenue row, that's the top row there. And we're going to change that revenue row depending on what we recommended. We're not going to blindly use some historical percentage. Please see that here as it's talked about. So even if the firm historically on revenues has increased 3.5%, man, it could go up double that next year or over the next 3 years, depending on what you're recommending. So in your projected financial statements, I'm going to need you to work row by row all the way through the income statement and then the balance sheet, working row by row, asking yourself for each row, given what my partners or myself are recommending this firm do for the next 3 years, how do I think that row is going to change? What's my best estimate for how that row will change? So keep that in mind as you work through this process. This is not a difficult concept, and it's tremendously important. In fact, folks, after getting command of these 8 pages, if I were you, I would put on my resume that I've gained experience developing projected financial or performing projected financial statement analysis, because that would really signal a tremendous skill to any recruiters out there that you're comfortable doing this. And even the smallest of businesses need to do this, have to do this. If they're going to the bank, let's say to borrow money, I mean, the banker is going to want to know, am I going to get paid back? Could you show me some projected financial statements, please, to reassure me that I should make you the loan so I can see that I'm going to get paid back. So on page 248 here, I see that at the bottom on step 3, it's talking about retained earnings. Please know that basic business formula that net income minus dividends is equal to retained earnings. And that's a real important concept, because retained earnings, that retained earnings dollar amount, that row, that retained earnings is the link between a projected income statement and a projected balance sheet. In other words, I see this being talked about on page 248. We're going to do the income statement first, starting with revenues, work our way down to net income, Going to subtract off from net income any dividends that we pay, any dividends that we want to pay. And net income minus the dividends is retained earnings. And I see here on page 248, we're going to take that retained earnings amount and bring it over to the balance sheet. Notice on the balance sheet at the bottom of every balance sheet I've ever seen, there's a row that says retained earnings or accumulated surplus, something like that. But normally it says retained earnings. And we add to that number every year the retained net income minus dividends coming over. That's what it's talking about here on page 248. And you can do this, and it's going to be tremendous once you're able to master this. I'm going to look for this in your comprehensive strategic plan that you develop and see that this has done in a reasonable manner, okay? So I see step 5 on page 248 in table 8.4 is talking about cash there. The template is going to use cash as the plug figure. In other words, we're going to work from the bottom to the top on the balance sheet. Remember, the retained earnings row is near the bottom. We're going to work row by row. For example, we come to like long-term debt. We're going to ask ourselves, what did we need to do with on that given our EPS EBIT analysis? Are we using debt or not to raise capital? Same thing with the paid in capital row. Another name for that is capital surplus. That's where new equity goes. So you can keep it the same or increase it or decrease it, depending on what you had decided to do with your EPS EBIT analysis in terms of raising capital. You understand? So that's kind of what we're going to do. Look at each row and make an adjustment based on what we're recommending the company to do over the next 3 years, working our way from the bottom of the balance sheet to the top. So we'll get a total liabilities and equity number. We'll transfer that right on up to the total assets number, continuing to work our way up to the top. We'll come to items such as property, plant, and equipment. And you're going to ask yourself on that road, my goodness, am I building new stores? Am I building new manufacturing plants? If yes, what's an appropriate number to put there to change that over the next 3 years? So I'm going to need to see in this strategic planning project you're developing 3 years of projected financial statements. Now I see in that table 8.4, when it's talking about cash there at number 5, it says the template is going to automatically make this thing, your balance sheet balance. I mean, a balance sheet is called a balance sheet because it needs to balance. And the template will use the cash account to make it balance. But guess what, folks, as it says there, it'll put $1 trillion there for cash if that's what it needs to balance. So accountants, CPAs, what they do, they work through these projected financial statements. They see what that cash number is, and then they make some adjustments. That's what it's talking about here on page 248. If the cash is too high, go ahead and pay off some long-term debt or something like that to lower that cash to a reasonable amount with a current ratio, let's say of roughly 2.0. You know what current ratio is, current assets divided by current liabilities. If that cash number is too low, that's a barometer letting you know you're actually going to need to borrow more money or issue more equity for the firm, the company to stay financially healthy and all. So that's what's being described in table 8.4 there. As I move on over to page 250, what I see here is step by step, by line by step, how to do this. Because I want to make really sure you're able to do this and you gain confidence developing projected financial statements. I see step 1 there, just kind of reiterating on page 250. So we're going to start with the income statement. That means we're going to start with the revenues. That is the top row. And we're going to ask ourselves, as a reminder here, given what we're recommending this company to do, how do we think that revenue line needs to change? I mean, we can look at the historical percent change, but that's not going to govern and control the number we're going to say for the template to do with regard to the revenue row. Okay. And step 2 on page 250, use percent of sales method to project cost of goods sold and operating expenses, unless we have some reason to change that percentage. I mean, if you're using some form of backward integration where you're gaining control of suppliers and raw materials, perhaps you can lower this cost of goods sold percentage, but otherwise probably keep it the same. That's what it says here on page 250. Step 3, calculate projected net income. And remember what we do next? Subtract off dividends. And what is net income minus dividends? retained earnings. I see that being talked about right here. And we're going to project the balance sheet. I see with step 5, working from the bottom to the top of that balance sheet, beginning with which row? Retained earnings row, and it's way down near the bottom of that balance sheet. And be mindful, that retained earnings row, folks, that's monies that have been reinvested back in the company over its life, over many years, maybe many decades. It is not cash in the bank. Please know that retained earnings row that you see on the bottom of every balance sheet I've ever seen. So step 6, as we mentioned a second ago, we're going to use cash as the plug figure, and we're going to make some adjustments probably. Rarely on our first time through on developing some projected statements is the cash figure perfect. We're probably going to need to make an adjustment. That is, lower the cash. You know, if you lower an asset, you maybe lower a liability like long-term debt. I mean, you're paying more on the long-term debt than you're getting on interest in your cash. And cash is like the company's checking account. Okay, so that's what it's talking about in step 6. And finally, step 7 says, well, give some notes to clarify for the reader the significant changes you made on particular items and rows. I see this on page 251 at the top in step 7. That's always nice to do. Even in your comprehensive strategic planning project, give us some notes or comments to help the reader, your audience, with regard to the major changes that you made on, for example, long-term debt row or paid-in capital row or inventory row or property, plant, and equipment row, those kinds of things. So what we have here in chapter 8 on page 251, we start through with the actual projected statement analysis for Procter & Gamble. I see this. Notice as you see on table 8.6, the bottom of page 251, this thing goes from left to right. Notice 2016, 2017 is to the right of that. Remember, in the template's always going to want to use it to array these columns going from left to right, higher years to the right. And so I see on page 252, Procter & Gamble's actual balance sheets. That's their actual balance sheet for Procter & Gamble. That's their actual balance sheet. And you see that for 2016, 2017. Now, straight from the template, that table 8.7 is straight from the template. Remember, it gives you the percentage change in each row. And so what we're doing with Procter & Gamble, as you see on page 251 and 252, I see on page 251, what we're going to do over the next 3 years, we're going to add 5 new manufacturing plants at a cost of $250 million each. That's a $1.25 billion total. So that's going to be controlling our property, plant, and equipment row, you understand. So on page 251, I give you here 2 recommendations followed by 2 more on page 252 so that you can see, so that we can follow what's going on with these projected statements in light of what we're recommending. Now that's what I'm going to need you to do. I'm going to need you to develop a projected income statement and a balance sheet based on what you recommend the company to do. So you can't even start these projected statements until you have a set of recommendations and the costs associated with them. And that's what we're going to try to reflect in these projected statements. So anyway, these statements here on page 252, 253, Procter & Gamble is going to increase dividends by 1% annually. I see this on page 252. And we're going to get 40% of our capital from debt. That's number 4 on page 252. And that means we're going to get 60% of it from equity. So that's letting us know that was our conclusion from our EPS EBIT analysis. So we're going to look for that to be manifested in the projected balance sheet. So on page 253, I see the projected income statement, the changes in revenue and these other items based on those 4 recommendations, you understand, rather than blindly using some historical percentage. I see the net income, for example, for 2020 on page 253 to be 9.9 billion. You see that? 9.9 billion. Okay, and then we work on to the balance sheet on 253 and 254. Remember what we do with the balance sheet? How do we start that projection? Start from the retained earnings row near the bottom and work our way back up to the top. And I see that's done for you on page 254. And then folks, our co-authors and I, we provide elaborate notes for you here in table 810 to explain every row why it changed what it changed. That's our best estimate of what it would have been for Procter & Gamble, given if they were going to follow those 4 recommendations. So this is exactly what I want to see you try to do in your comprehensive strategic plan for your company. And if you're able to master this, I'm going to be thrilled. And like I say, I would encourage you even to put this on your resume if you do get command of this, particularly in using the template. I mean, you can say gain experience developing projected financial or performing projected financial statement analysis using widely used Excel-based strategic planning software. I mean, if you have that on your resume, that's a tremendous skill to showcase out there to potential employers, that you have some command and understanding of income statements and balance sheets. Okay, so finally, on page 255, it talks about the retained earnings data table and the financial ratios. You understand? Scroll all the way down to the at the very bottom of the template. Scroll all the way to the right, and you'll see projected financial ratios. The template's going to calculate automatically projected financial ratios for you based on your projected statements, and that's wonderful. And it's going to calculate for you a retained earnings table that I see on page 256, something like that for Procter & Gamble. And notice the far right column in table 811, the 98,089 and 102,775 and the 102,725. That right column, folks, needs to match the retained earnings row on your projected balance sheet. So notice that far right column on page 256 in table 811, please see that it matches perfectly with the retained earnings row, on the prior page for Procter & Gamble. I see it on page 254. So 254 retained earnings row matches the column 5 on page 256. You want to check for that in your comprehensive strategic plan, because if that far right column in your retained earnings table doesn't match with the retained earnings row, then there's an error somewhere, so you'd want to go back and double check that. But thank you so much for listening in on this. I'm going to be so excited to see this, see you gain command of this concept right here. It's indicated by the 8 pages of coverage, more than any other topic in the textbook. It's very, very important in business. And like I say, even the smallest of businesses have to know how to do this. You don't need to go to a CPA firm to do this. You can do it. You can do it for your banker. You can do it. Even for a small business, you can do it. Using the template and using these guidelines right here on these 8 pages. I appreciate you being with me on this one. I really do. Take care. Thank you. We'll see you soon on our next segment.